Hello and welcome to this week's edition of Checks and Balances TV. I'm your host, Matthew J. Rettick, and I'm committed to giving you the truth you need to financially succeed. Today's program is on the estate planning mistakes of the rich and famous and how you can avoid the same problems. Let's first of all, though, review today's headlines and see how it may impact your financial future. Next Monday is Valentine's Day, and the IRS has nothing but love for your money. Last month, the IRS announced it wouldn't begin taking tax returns with itemized deductions until February 14th this year, which is Valentine's Day, the day typically reserved for love, not taxes. Late last year, the IRS reported that they would need extra time to reprogram its processing systems to accept itemized deductions, since Congress didn't settle on the 2011 tax code until December 17th, less than 2 weeks before the new year and new laws began. Thanks to the same tax package, the estate tax is back. The new tax rates come in at 35% with a $5 million exemption, falling in between the record low of 0% last year and the pre-Bush tax cuts high of 55% with a $1 million exemption. And it appears that the 2010 retroactive estate tax debate has been put to rest by Congress once and for all, as they've now conceded that a retro tax going back to the start of last year could be considered unconstitutional and challenged by law. Okay, so what's really going on here? Let's check the facts using our checks and balances process. The IRS will start to accept tax returns with itemized deductions this Monday, February the 14th, potentially delaying the filing of tax returns for more than a third of the country's taxpayers. The 2010 tax season officially began on January 14th for standard filers, but for anyone who wanted to cash in on the tax breaks they qualified for in 2010, they're going to have to wait until now to file their returns. Why the delay? It's due to the Tax Relief Unemployment Insurance Reauthorization and Job Creation Act of 2010, and that's a mouthful, which wasn't signed into law until December 17th of last year. The IRS had less than a month to prepare its tax return processing systems, as the new tax bill extended a number of expiring provisions, and payroll managers at companies nationwide had less than 2 weeks to prepare for, update, and implement all the changes to income and payroll taxes. The final law kept federal income tax rates the same for an additional 2 years and extended itemized deductions for all taxpayers, including high-income earners. As a result of the delay by Congress in making a decision, more than 50 million taxpayers with itemized deductions had to hold off filing their returns until next week. In addition, several million more standard filing taxpayers had to delay filing their returns as well, as the IRS needed extra time to prepare for non-itemized deductions that were reinstated as part of the tax package. In general, the delay affected Americans who file a Form 1040 and use a Schedule A. This would include those who claim the new educator expense deduction, which credits grade school teachers for out-of-pocket expenses of up to $250, as well as those claiming the higher education tuition and fees deduction for college tuition and expenses of up to $4,000. Now, while only 9 million of the 140 million U.S. taxpayers filed their returns in January or February last year, if you're an early filer, the IRS has requested that you have a little extra patience. They've asked that people wait to send in their itemized tax return until at least February 14th, after they're fully equipped to process the returns. The newest tax bill that passed at the end of last year also included a change to the estate tax. Prior to the Bush tax cuts, the estate tax rate was as high as 60% on estates valued at more than $10 million. The new $5 million exemption and 35% tax rate is considered a nice compromise, at least for some lawmakers. However, a number of other lawmakers were quite unhappy with the estate tax repeal last year and became increasingly upset as 2010 progressed and at least 5 billionaires passed away, leaving non-taxable fortunes to their friends and family and not the IRS. The rumor of a retroactive estate tax was tossed around throughout 2010, but was eventually squashed at the end of the year, due at least in part to the statements made from some attorneys of the recently deceased. They were calling this move unconstitutional and threatened legal action if Congress went through with it. So Congress made another compromise. The executors to the estates of those who died in 2010 now had an option. They could either pay the estate tax or not pay it. The trade-off was this. If they didn't pay an estate tax, they would be subject to the higher capital gains tax rates that came with the 0% estate tax last year. Any estate worth more than $1.3 million was subject to capital gains taxes on the difference between the original cost basis, or what they originally paid for the asset, and the current market value of that asset. Spouses were allowed an additional $3 million exemption, but if you were a billionaire, your spouse would be paying 15% on anything above $4.3 million. If the executor did elect to pay the estate tax, they would have to pay the new estate tax rates of 2011 for a death in 2010. The estate tax exemption under the new law for 2011 is $5 million. So many Americans will not have to worry about passing on their entire estate to their loved ones. Estates under $5 million would be better off by last year's rules. However, those that have wealthier estates really need to crunch the numbers carefully. Okay. So you may be asking yourself, Matt, what does all of this mean to me? Well, now that we've checked the facts, let's balance this news using our checks and balances process to determine what action you should take today. If you file a return every year that includes itemized deductions, be sure you take advantage of every one you can. Some of the more commonly overlooked tax deductions include interest on mortgage payments, carrying forward investment losses, and deductions for child care. If you've bought energy-efficient appliances in the last year, 30% of the cost, up to $1,500, is now tax deductible. Also, if you need help understanding the more than 70,000 pages of the tax code this past year, hire a professional to file your tax return for you. The fee you pay them for this service may also be considered tax deductible. The IRS, with all its power, can be brought down by an act of Congress, or at least held back. And although the IRS Commissioner says the majority of taxpayers will not be impacted by their delay in receiving itemized tax returns, more than a third will be. There is, however, a thin silver lining. You will have 3 extra days to file your return this year. Due to the Emancipation Day, the official tax day for 2011 will fall on April the 18th. When the family of self-made billionaire Dan Duncan was asked what they thought about the estate tax potentially being retroactive in 2010, they said it would make little difference to them. Duncan, an oil executive in Houston, Texas, and listed in Forbes magazine as one of the top 100 billionaires in the world, had already gifted most of his estate to his 5 children and 9 grandchildren well before his death. With all the new tax laws in 2011, you should be well motivated to review your current estate plan. You know, it seems as though Congress changes the rules and laws every couple of years, keeping tax attorneys, accountants, and anyone with an estate working hard to stay up with the new laws and maximizing what can be passed on to family and heirs. Since the new Congress has been in session this year, they're trying their hardest to create certainty with the death tax. At least 5 new bills have been introduced in the House this year to eliminate the estate tax altogether. 3 of them being the Fair and Simple Tax Act of 2011, the Permanently Repeal the Estate Tax Act of 2011, and the End Tax Uncertainty Act of 2011. Okay, so what's the bottom line here? It really doesn't matter who you are or the size of your estate. If you have any kind of assets and a spouse, children, or favorite charity, you need to create an estate plan and update it often. And be sure to protect your estate and heirs from overpaying any kind of taxes. In the meantime, be sure you take advantage of every deduction available to you. More deductions mean more money for you and less money going to the IRS. And while you must pay your taxes every year, you don't need to pay a penny more than you legally owe. And if you're filing your return later this year than usual, exercise patience. Even though the IRS is running a bit behind, they eventually collect what's theirs. And by the way, that's spelled T-H-E-I-R-S. In this week's CBTV poll, we asked Americans an important question. Do you currently have an estate plan in place? The options were A, yes, I do. B, yes, I've started one. C, no, but I plan on getting it done. Or D, no, I don't. Well, 47% of you said that you do not have a current estate plan in place, but plan on getting it done soon. Don't procrastinate. No one has a contract with life. Good intentions don't count when your estate goes before a probate judge. So take action now. Call an attorney, make an appointment, and discuss with your spouse or family what you want to have happen to all of your assets once you're gone. If you don't take action and something happens to you, your estate could be held up in probate for years. So do it now. In our On the Street segment, we travel the country to ask Americans what they think about an important financial topic or issue. For this week's segment, we ask people their opinion about the estate tax and the income they can depend on for sure after their spouse passes away. Let's take a look at what America had to say. What do you think is going to happen to the estate tax? Right now, there's no estate tax when you die.
Well, they already said it's going to be 55%. So based on what they're saying, I think it's going to be 55%.
Yep.
So a lot of farmers are going to lose their farms, and a lot of businesses are going to lose their business because the land or the equipment could be worth a lot of money, but they don't have a lot of cash in there. Then Uncle Sugar comes in and says, I want $100,000, and if their thing is only worth $150,000, they got to sell it off just to pay the tax.
That's true. That's exactly right. Now, George Steinbrenner just passed away, so his family's going to save a lot of estate tax.
That's right, because he has to pay nothing this year.
But the average person, you're right, who has an estate of more than $1 million, $2 million, is going to end up paying about half of anything above probably $1 million in estate taxes.
That's correct. And unless you have a lot of cash in the bank, you're going to have to sell off your property in order to pay it.
The one thing that would be life-changing is if one of us were to die, would be that, we both, contribute to the income stream for our housing costs and other costs, and that would have to be, a major adjustment.
And many people that have a pension have it set up where upon their death, it either ends or they only then send 50% on the monthly benefit to their current spouse. Do you know how?
I think mine ends.
Yours is which way?
It will end.
It will end.
It will not go forward.
Okay, it doesn't go forward.
No.
Those were some very good points. And that gentleman was right. George Steinbrenner's family sure did luck out with no estate taxes due in 2010. And now for Matt's weekly tip, tool, or technique. Let's learn from the estate planning mistakes of the rich and famous. In celebration of Valentine's Day, we're going to cover the 4 C's that your spouse or significant other will really appreciate. No, we're not talking about diamonds. We're talking about the 4 C's to ensuring your financial wishes are honored. Child actor Gary Coleman passed away in 2009 after a divorce with his ex-wife, Shannon Price. One will named a friend as the beneficiary of his estate, and another handwritten will named Shannon as the beneficiary. However, the couple had divorced since it was written. While the courts were deciding which will was valid, 2 more estate planning documents surfaced that further complicated the estate and extended the probate process. So here's the first C. Be sure you have only one complete estate plan that details who is to receive your assets, how much they are to receive, and when they are to receive them. Actor Dennis Hopper filed for divorce from his 5th wife in January of 2010, a process that was underway but not finalized when he passed away in May. In his will, he stated that she was not to receive any inheritance if they were divorced or no longer living together at the time of his death. However, the language was not very clear. They both lived on the same property when he passed away, just not in the same house. His ex-wife continues to fight Dennis's children for what she considers to be her fair share of the estate. So the second C is be sure you're very clear about your final wishes and whether you choose to include or exclude a person or any persons from your will. Actress Farrah Fawcett updated her will in 2007 when she learned of her cancer. She left the majority of her estate to her son Redmond. Redmond, who has struggled with drug and alcohol addictions, receives his inheritance in the form of a monthly allowance as well as a fund to purchase a home. Farrah created a trust for Redmond to control how he spends the money, ensuring her life's work would not be used to fuel his addictions. So the third C is if you're concerned about how an inheritance could be abused by a child or heir, create a plan to control when and how the money will be distributed to them and how it must be spent. Elizabeth Edwards signed her final will just days before her death. In it, she was very clear how she wanted her assets and personal effects distributed upon her death. Everything was to go to her children. She did not name her ex-husband, former Senator John Edwards, as a beneficiary anywhere in the will. So the fourth C is keep your estate and beneficiary documents current by updating them as soon as a life change takes place, including pregnancy, marriage, sickness, death, or divorce. Now is the time to realize that only you are responsible for making sure you have a clear, concise, current, and controlled estate plan in place. As you can see, even our country's richest and most famous celebrities are not immune to mistakes in their estate planning. And the seemingly smallest overlooked detail can turn into a long, grueling, and expensive probate process in the future. Make sure your estate plan has the 4 C's included in it, and your loved ones will be eternally grateful. Mark your calendars now for the next installment of our Truth About series. This upcoming episode will air later this month and is on the truth about stocks. You will learn the pros and cons, both sides of the coin on this important financial product, so you'll know if it's the right investment for you. And be sure to friend our Facebook page and subscribe to our YouTube channel to gain exclusive access to our library of viral videos and the lighter side of finance. For more information on how to become a checks and balances savvy consumer and to download any of our free reports, visit the download section of our website. Also, be sure to get your copy of the 3 Pillars of the Checks and Balances Life, a free report that gives you a guide for truth and accountability in today's challenging financial world. And while you're on the site, remember, your voice counts. Be sure to take this week's poll and visit our Tell Us What You Think section to share your opinion. Make your voice heard. And finally, remember that only you can control your financial future. You can succeed. You just need confidence and determination. I'm Matthew J. Rettick from Checks and Balances TV. Be sure to join us next week when we'll discuss $14 trillion and counting. Where is the president spending our money now? Until then, spend less, save more, believe in yourself, and make it happen.